My name is Farhan. In this video, you will solve question number 4 from 2019 past exam. This question requires you to prepare adjusting general journal entries and also discuss an accounting assumption behind why we prepare adjusting general journal entries. You are also required to prepare an income statement at the end. If you need tutoring sessions, make sure to check the link in the description to book a call. With that being said, let's get started. Clapper Bikes sells customized motorcycles. The business commenced operations on 1 June 2019 and will report monthly. So this is a new business which just started on 1 June 2019, and we also understand that the business prepares its financial statements on a monthly basis. We are given the pre-adjusted trial balance as of 30 June 2019. So all the numbers that we are given here is prior to any adjustments that we need to make at the end of the financial year. Those adjustments are given under the additional information. The first one says advertising of $15,000 plus GST was prepaid for 6 months on 1 June 2019. And then you can see we are given other similar things that we need to incorporate in our workings before we prepare the requirements of this question. The question requires us to prepare the general journal entries on 30 June 2019 to record the additional information. You don't need any narrations. So on the right hand side of the screen, you can get to see all the workings that I have done. So I'll explain you each and every working step by step. So make sure to follow through towards the end of the content. So let's go back to the first additional information that we had. Advertising of $15,000 plus GST was prepaid for 6 months on 1 June 2019. You can see that I've drawn an arrow here which points us to the pre-adjusted trial balance, and we can see the balance for prepaid advertising of $15,000 that is given under the debit column. Now, why is prepaid advertising of $15,000 debit? This is because prepaid advertising is a current asset. Prepaid advertising simply means that we have paid for something in advance, and therefore we are still yet to consume the economic benefit that comes from that advance payment. However, from 1 June 2019 until 30 June 2019, 1 month has already passed, which means this prepaid advertising needs to be expensed based on the proportion for the 1 month of advertising. How do we find the advertising expense for 1 month? On the right hand side, you can get to see that we have calculated advertising expense per month to be $15,000, which is the amount for prepaid advertising that you get from the trial balance, and then you divide with 6 months. Why is it 6 months? Because the question explicitly mentions that the prepaid advertising that we have been provided relates to 6 months of advertising and was paid on 1 June 2019. We are expensing 1 month because 1 month has passed from 1 June 2019 until 30 June 2019. So $15,000 divided by 6 months gives us $2,500 per month, which is the amount that we need to expense for the financial year ending 30 June 2019. Actually, for the month ending 30 June 2019. So how do we expense this advertising? We debit advertising by $2,500. Why are we debiting advertising by $2,500? This is to reflect the expense that has taken place for advertising. And always remember, all expenses by default are debited. The opposite of expenses are income or revenue, which are always credited, which means expenses are always debited and income and revenue are always credited. So you need to remember this as a fundamental rule for accounting. We are crediting prepaid advertising by $2,500. This is to reflect a reduction in the current asset for prepaid advertising. You see in the pre-adjusted trial balance, the prepaid advertising is given as $15,000 debit because it is a current asset. But now that we have expensed 1 month of advertising, which is $2,500, we have to reflect this within the balance for prepaid advertising. And therefore, we have to credit prepaid advertising by $2,500 to reflect a reduction in the balance of a current asset. Assets by default are always debited, which means when assets increase, they're debited. Now that asset is decreasing because of the advertising that we have consumed, we have to credit it to reflect that reduction. So this is the first pair of journal entry that we need to include as our final answer within the general journal that's given here in the outline. Okay, now we're going to move to the second additional information, which has to do with rent. So rent of $5,500 plus GST per month is paid at the end of each month for the following month. Due to an oversight, the rent for June will be paid on 7 July 2019. So what we understand is that the business pays for the rent in the next month. Okay, so at 30 June 2019, the business had incurred rent expense of $5,500, excluding GST. Now, what do we have to do with this rent? This rent will be paid in the next financial year on 7 July 2019, or the next financial period on 7 July 2019. In the books on 30 June 2019, we have to recognize this rent as an expense because we obviously utilized the space for the business. Therefore, we have to debit rent expense by 5,500. But at the same time, since we didn't pay this rent, we have an obligation. In fact, the business has a present obligation for services it has already consumed. And that is why we are crediting accrued rent by 5,500, which is a current liability. And given that liabilities by default are always credited, or when they increase, they are credited, we are showing accrued rent on the credit side to reflect an increase in the current liabilities of the business. And the amount is $5,500. So the pair of journal entry in this case is debit rent expense by 5,500 and credit accrued rent by 5,500. We do not have to take care of GST in this case because GST clearing is either a current liability or a current asset, depending on whether you are paying for services or whether you are getting it from your customers. In the income statement, which only deals with revenues and expenses, we do not include anything that has to do with GST. That has to only go into the balance sheet where you use the GST clearing account. If the GST clearing account has a credit balance, it's a current liability, meaning that the business has collected more from its customers compared to how much it has paid. But if the GST clearing balance is debit, that means that the business has a current asset, which refers to the fact that the business has paid more in GST rather than it has received. Again, that is not important in this case, but you can keep that knowledge for future reference if you need to use it. Point number 3, additional information number 3, which says on 30 June 2019, wages owing to employees were $2,000. Again, this refers to a current liability for the business because the business has utilized the labor from its staff and employees, but is yet to pay $2,000 worth of wages. Now, wages is an expense because it is a cost that the business has already incurred for the month ending 30 June 2019. Given that all expenses are debited, we have to debit wages by $2,000, right? And we are crediting accrued wages by $2,000 to reflect an increase in the current liabilities of the business or a present obligation of the business because of the services it has consumed. Accrued wages here refers to current liability as we already understand, and that is mainly because the question explicitly mentions wages owing to employees on 30 June of $2,000. So this pair of journal entry is to debit wages by $2,000 and to credit accrued wages by $2,000 to reflect an increase in the current liability. Additional information number 4, the business has a markup of 100% on cost. Now, we do not really have any additional information, any journal entry to do in this case, but let's understand what the question is trying to say. You can see in the trial balance that the sales revenue is $900,000, as you can see on the credit side. And then you can see the cost of goods sold, which is an expense, obviously needs to be included on the debit side. Now, the sales revenue being $900,000 and the cost of goods sold being $450,000, you can see to go from cost of goods sold to sales revenue, there is a $450,000 increase, which refers to the 100% markup on cost. Basically, the business pays $450,000 to bring the inventory, which it then sells by adding an extra 100% markup on top to its customers. So that is where the markup of 100% comes into existence. So the cost being to the business of $450,000 and the sales revenue after the 100% markup is basically double the amount of cost, and that becomes $900,000. So the gross profit in this case is $450,000. As you can easily see, sales revenue minus cost of goods sold equal to $450,000 as the gross profit, which is something you will see that we eventually include in the income statement in part C. Now let's move to additional information number 5. The business invested excess cash in a 12-month term deposit on 15 June 2019, which is earning 3% per annum. The interest is payable annually on 31 December. All right. So first of all, we understand that the business has made some investments, and that investment is a term deposit. If you check the trial balance, the pre-adjusted trial balance, you can see that the term deposit is $240,000, and that is on the debit side. Why is it on the debit side though? Because this is an investment that the business has made. So therefore, this is a non-current asset for the business. The business has made some investments, maybe in a bank, and the business gets some interest revenue or interest income because of this investment that it has made. Now we want to find that interest revenue on a monthly basis using the annualized interest rate of 3% per annum that we are receiving. So how do we find that? So interest revenue per annum equal 3% multiplied on the original term deposit, the total balance of $240,000, and that gives us $7,200 as interest revenue on an annual basis that the business expects to earn. Now, why does the business expect to earn this? This is because the interest is payable annually on 31 December. The interest is payable to the business annually on 31 December. So which means the business still hasn't earned it yet, but based on the calculations, we understand that on an annual basis, the interest revenue should be $7,200. But on a monthly basis, obviously you divide the annual figure of $7,200 by 12 months, which comes out to be $600 per month. But if you look into the question carefully, you will see that the investment was made on 15 June 2019, which is halfway through the month of June. Given that we're preparing the reports for the month of June, we now need to calculate the interest revenue that the business has actually earned for the month of June. And that would be for the remaining half, which is the 15 days left in June from 16 June until 30 June. Right. So that is why after finding the interest revenue on a monthly basis, we again divided it by 2 to convert it into 15 days, which gives us $300. All right. Now we understand that this interest revenue is something we still haven't got in cash or in terms of revenue yet on 30 June 2019. This is expected to be received at the end of 31 December 2019. So therefore, when the business prepares its books or when the business prepares its reports, the business will recognize this as a current asset that it expects to earn in the near future. So therefore, we have to debit accrued interest revenue, which is a current asset account. Accrued interest revenue, because explicitly mentions revenue. So accrued interest revenue is a current asset account, and assets by default are debit. And because there is some income that we expect to receive in the near future, we are debiting it to reflect the increase in current asset by $300. And at the same time, we have also earned a revenue, which is $300. Being the interest income, we credit interest revenue by $300. Again, always remember all revenue is credited, all income is credited, all expenses are debited, all assets are debited, and all liabilities are credited. Okay, so this pair of journal entry relevant to additional information number 5 is debit accrued interest revenue by $300 and credit interest revenue by $300. Next, we're going to look into the last additional information that we have. The vehicles were purchased on 1 June which is when the business commenced, and are to be depreciated at 20% per annum using the reducing balance method. All right. Now, if I want to find the depreciation in the first year of usage for this vehicle that we're talking about, the balance is given in the trial balance as $180,000. So that is what we have paid to purchase the vehicles. So to find the depreciation on an annual basis, we take the rate of 20%, we multiply it on the cost of 180,000, and then on an annual basis, the depreciation of vehicles is $36,000. But we understand that we report on a monthly basis. Therefore, we have to convert this annualized depreciation into a monthly depreciation by simply dividing $36,000 with 12 months, which is $3,000 per month. Now, every time you incur depreciation expense, the recording is straightforward. You debit depreciation of vehicles by $3,000, which is an expense item for the business. And like we have already discussed, all expenses are debit. So we are debiting depreciation of vehicles by $3,000, and we are crediting accumulated depreciation of vehicles by $3,000. Now, what is the accumulated depreciation of vehicles account? So this is a contra asset account, which refers to the reduction in the value of a non-current asset that we had previously purchased. So rather than reducing the value of the non-current asset, within the non-current asset cost account itself, we create a contra asset account to reflect the reduction in the value that has been lost due to the usage of that non-current asset. And that is known as accumulated depreciation of non-current assets, which in this case is accumulated depreciation of vehicles. You always credit it because it's a contra asset account. So contra here means this account is just on the side to show a reduction in the original value of the non-current asset, which are the vehicles. So credit accumulated depreciation of vehicles by $3,000. So the final pair of entries for point number 6 is debit depreciation of vehicles by 3,000 and credit accumulated depreciation of vehicles by 3,000. So you can include all these calculations in the outline here. So I'm not going to be including that here, but you get the idea for each and every pair that we have solved today. Now the second part of the question, with reference to one accounting assumption, explain why is it necessary to record the additional information. So we're going to be using the accrual basis assumption in this case. And the accrual basis assumption calculates profits based on the revenues that the business has actually earned, subtract the expenses that the business has incurred for the period. So you see all these adjustments that we had to do at the end of the month. So we had to take care of the wages that we owe to our employees. And how did we do that? So we debit wages by 2,000 and then we credit accrued wages by 2,000. Why are we doing all this? We are ensuring that the revenues earned and the expenses incurred represent a faithful measurement of everything that goes on within the business in terms of actual revenues that the business has earned and the actual costs for that specific period that the business has actually incurred. And this helps to determine an actual profit and also supports proper decision making and strategic formulation to survive or sustain the business operations in the future. So the accounting assumption in this case we are concerned about is the accrual basis assumption. Next, the last thing is to prepare the income statement for the month ended 30 June 2019. Okay, so this is going to be pretty straightforward, and I believe you remember all the numbers that we have used so far. To begin with, we start with the revenue, which is the sales, and that is $900,000, and then we subtract the cost of goods sold of $450, and we get the gross profit of $450. We just had a discussion a while back regarding the markup thing, and yes, that was in point number 4. So sales revenue was 900,000 and cost of goods sold was 450,000, and these are the numbers that we have included here, and that gives us a gross profit of 450,000. Then with the gross profit, we always add any other income or the other revenue that we have. In this case, the only other income or revenue was relevant to the term deposit that the business has made, and in return, the business receives some interest. So the interest revenue of 300 for 15 days that we had calculated is the other revenue, and that is what we have included here. And once you add the interest revenue with the gross profit, you get $450,300. We do not have anything else in terms of revenue to include there, so we are jumping straight to expenses. So we got advertising in the first additional information. So we only expensed 1 month, which is $2,500. That is what we have included here. For the wages, we are including 192,000, which is because of 190K plus an additional 2K for the amount that we owe. Where does the 190,000 come from? Let's scroll back up to the pre-adjusted trial balance, and you can see that wages, we had already incurred wages expense of $190,000 before, and what we were left with is to add the other $2,000 at the end of the month. So that is basically what we're doing here in this case. So to find the wages total, we add 190 from the trial balance plus an additional 2,000 from the additional information, and that gives us 192,000. Rent expense is 5,500, if you recall from additional information number 2. And then we have depreciation of vehicles, which we calculated in additional information number 6, and that was 3,000. So all the expenses are taken care of here. You just simply add them, and you should get 203,000. Then you subtract the total of expenses from the total of gross profit and other revenue, and then you get the net profit of $247,300.